Are you invested in the standard 60-40 portfolio? If so, you might be leaving gains on the table, or even worse, exposing yourself to risk of major loss over the coming years and decades. In fact, even Blackrock has now moved away from the standard 60-40 portfolio advice, saying that investors can profit from diversifying beyond it. So what is the standard 60-40 portfolio? This is considered traditional financial advice, even though historically, it's actually relatively new, and it says that you should have a mix of both stocks and bonds. The younger you are, the more stocks you have and the fewer bonds. And as you get older, you switch out that allocation so that when you're really old, you have mostly bonds and few stocks. The idea behind this is that when you're young, you want to take on more risk for more potential growth. And as you age, you don't want as much exposure to volatility and you want more bonds for predictable income. The other reasoning behind it is that as markets crash, usually bonds are the safe haven. And so when your stock portfolio goes down, your bond portfolio will go up and that will compensate for some of your losses along the way. You can rebalance and overall your gains will be smoother and hopefully even better. The problem is, as the wise Yogi Berra once said, in theory, there is no difference between theory and practice, but in practice, there is. Now, this idea goes along with Harry Markowitz's theory called modern portfolio theory that he developed in the 50s, which establishes an efficient frontier with all investing strategies. And that basically, if you want more returns, you have to be willing to accept more risk. And there's always a trade-off there. And if you don't want to accept the higher levels of risk, then you will just have to be okay with accepting lower levels of returns. Now, many people are not aware that Harry Markowitz actually hated this theory. Within just a few short years of publishing it, he was trying to get people to not accept it, not talk about it. And he was saying, hey, I was wrong here. And unfortunately, it still took off. But the reason why he was saying, hey, people shouldn't be looking at this and basing their investing decisions off of this is because it assumed a normal distribution of returns in markets, which doesn't exist. In life, there are two forms of distributions of outcomes. You can either have a bell curve or normal distribution, or you can have a power curve, also known as a Pareto distribution. Things like human weight and human height fall into the category of a normal distribution. In other words, most people fall into the middle categories here of being average height or average weight. Yes, there are some people with lower height or lower weight and some people with higher weight and height, but the vast majority fall in the middle. But there are other things in life that don't follow a normal distribution. Things like wealth, population of cities, the density in galaxies, and many other things across nature follow power law distributions. In other words, a small percentage of the people hold a large percentage of all the wealth, and the rest of the wealth is not evenly distributed, but it is distributed among everybody else to a smaller and smaller extent. The same thing is true of population in cities. A few cities have almost all the population, a few galaxies have almost all the mass, and the rest is spread out among a high number of low performers. This is exactly how markets work as well. Markets do not follow a normal distribution of returns, both in terms of time periods, in terms of asset classes, and in terms of individual assets, they all follow power law distributions. This is why when you look at stock market indexes like the S&P 500, the vast majority of the overall performance of an index made up by 500 companies comes from only the top 10 companies in the index. This is not a problem of how the system is constructed. This is the very nature of anything that is not governed by those normal distribution laws, just in nature, inherently. This is how stuff like this just works. This is not something that can be changed with policy, with laws, with technology, or good intentions. You might be able to change which companies get those outsized returns for the entire index, but you can't change that it happens. Now, the second big problem with constructing your portfolio based off of these outdated and disproven theories is that we are not in a bond bull market anymore, which means you shouldn't be allocating 10% of your portfolio to government bonds, let alone 40% or more. This is a chart of interest rates from 1980 through 2020, and you can see that it does one thing and one thing only, and that is go down. Interest rates and bond prices are inversely correlated. When rates are dropping, that means bond prices are rising and vice versa, which means for 40 years, from 1980 through 2020, bonds were in a bull market, which means for longer than your financial advisor has been in business, and for many financial advisors, longer than they've been alive, bonds have only done one thing, and that is go up in value. The industry is built on thinking this is normal, but guess what? It's not normal, because if we take this chart back and we look at what happened from 1940 through 1980, which is the 40 years that preceded the last 40, we can see that rates did the exact opposite. They only went up for 40 years straight, which meant for the prior 40 years, bonds were in a perpetual bear market, which meant they were the last thing that you wanted to hold on to in your portfolio for the long term, especially if you might have to sell them prior to maturity, because you would be taking a loss. And finally, I want you to take a look at this chart, which is what interest rates have done since they bottomed in 2020 at the end of that last cycle. And that is, again, they've been going up. We are in a new phase of the long-term debt cycle. The one from 1980 to 2020 has ended. That was a disinflationary levering up from the government. That caused interest rates to go down as the government borrowed more and more, stimulating the economy and boosting asset prices. But the next 20 to 40 years will look very different than the last 40 years, and will look much more similar to the 40 years that preceded that. In other words, the government will need to go through a deleveraging. It will be inflationary, just like the 40s through the 80s. Inflation will be moving higher, and rates for everybody like us will be moving up, which means we have entered into a new bond bear market, just like happened from 1940 through 1980. And most people advising you on what to do with your money were not alive back then, and were certainly not in business. And they have built their entire career off of the assumption that interest rates will always go down. And it's because they haven't lived through a deleveraging. They've only lived through governments levering up. I want to be clear. I am not saying that I think government spending will go down. I'm not saying I think government taxing will go down, or at least not significantly over the long term. I'm not saying that government borrowing will go down or even the national debt will go down. What I am saying is they're going to be printing more and more in order to pay for that increase in spending, with the goal of GDP growing faster than their debt. Because for a government, the only thing they care about is their tax base. Does their tax base grow at a rate that can pay for their debt? And if so, they're okay with it. So when a government deleverages, it means that the government's debt load compared to the GDP of the country it taxes, that ratio gets better, which means that people like you and I pay the bill because all of the cost of that debt is offloaded onto the economy through inflation, which is the third reason why you don't want to be in bonds, because they're going to pay you a negative interest rate when you compare it to real inflation. For the last 100 years, the majority of the time, government bonds pay a real negative interest rate, and that's just using the official inflation numbers. If you believe the official inflation numbers are somewhat understated, then even more of that time, you'd be getting an interest rate, a yield on your money that is lower than the rate of inflation. In other words, you're losing purchasing power by loaning your money to the government by buying bonds. This means that with your portfolio, you need to make sure you have real savings that historically preserve and slowly increase your purchasing power. That way, when you need dry powder, when you need to access your emergency savings, when you want to reallocate because there's assets on sale, you are able to because you own something that hasn't been eroded in its purchasing power from the government. It also means you have to take an active role in your investing. You can't take a passive role and just think, oh, the indexes will take care of me. Over the next decade or two, passive investing will give way to active investing again, just like it did from the 40s through the 80s, when active and value investing took off. There's the people like Benjamin Graham that trained Warren Buffett how to invest. You need to know how to pick and value stocks so that you know you're buying them at a good price, and you have a high certainty that they will continue to grow for you into the future. Now, if you don't know how to do any of this, I've created the perfect guide for you. It is called the Hedged Hypergrowth Portfolio Blueprint. It tells you everything you need to know about how to construct your portfolio in a way that is built for the coming years and decades, not the past. Right now, it's on sale. It's linked in the description below. I'm going to be doubling the price soon, so get it now while you can. As always, thanks so much for watching. Have a great day.